Hey folks, I hope you're doing fine. I'm Simo from Investment Research, and today is November 18th, 2025, and I need to clarify on what's happening with SoFi Technologies because this stock is testing investors' patience right now. From what I'm seeing, SoFi closed Friday at $27.82, down 2.80%, and in pre-market this morning it's trading at $26.56, down another 1.78%. You know, after hitting an all-time high of $32.73 just a week ago on November 12th, we're now down nearly 19% from that peak. So let me walk you through exactly what's happening, why the fall continues, what institutions are saying, and what the forecast looks like from here. Alright, so the question everyone's asking is why SoFi keeps falling and falling despite the crypto launch and strong fundamentals. From my research over the weekend and this morning, there are three main drivers behind this continued sell-off. First, according to the Motley Fool's analysis published just this morning, Cathie Wood is selling SoFi stock. The headline reads, "Cathie Wood is selling SoFi stock, should you?" And from what I've been studying, this is creating significant selling pressure. You know, when a high-profile growth investor like Cathie Wood sells after a massive run, retail investors who follow her trades often panic and sell too. According to the article, the digital bank stock is up 81% year to date. Even after this pullback, Wood's ARK Invest made notable trades on November 12th, trimming both Tesla and SoFi while making a $34 million bet on a USDC stablecoin giant. From my view, this is classic profit-taking behavior after extraordinary gains, not a fundamental concern about SoFi's business, but the market doesn't care about nuance in the short term. Second, from what I noted in my technical analysis, SoFi closed Friday at $27.82, then gapped down to around current levels, and now in pre-market we're at $26.56. According to the data, the stock has fluctuated between $26.55 and $28.69 during recent sessions, trading about 1% above the intraday low and 6.5% off the high. Moreover, according to Robinhood's data, current trading volume is 75.96 million compared to an average daily volume of 83.75 million, suggesting lighter participation which can exacerbate price swings. Third, and this is critical from my research, according to the Motley Fool's second article published this morning, titled, "This fintech stock had an incredible 2025, can its run continue into 2026? There's concern about valuation. From what they're highlighting, SoFi now trades at a price to tangible book value ratio of almost 4.7, which is a hefty premium to most banks, according to their assessment. Thinking ahead to 2026, SoFi's investment upside likely depends on the company sustaining or even improving on that growth. Sure, a stock's valuation can keep rising, but SoFi is expensive enough now that it seems doubtful there's enough room for it to easily match its 2025 gains again next year. You know, this is the classic Wall Street mindset. The stock went up 80%, so it must be expensive now, even if the business is executing brilliantly. From my view, this sentiment is creating a self-fulfilling prophecy, where investors sell because they think everyone else will sell because the valuation is rich. Current institutional ratings, Wall Street remains cautious. Now let me walk you through what institutions are saying because from my research, the street remains deeply divided. According to the latest consensus data I'm looking at, 17 analysts cover SoFi with an average rating of hold. The 12-month stock price forecast is $24.90, which represents about 8% downside from recent levels around $27. You know, when the average target is below the current price, that's a bearish signal that tells me most analysts think the stock has run too far. From what I've compiled, according to a broader sample, around 28 to 30 analysts cover SoFi with a wide range of 12-month price targets. One dataset shows consensus around $18 to $19, with a high target of $37 and a low near $3. Another analysis from 24/7 Wall Street cites a street consensus of $26.61, also below recent stock prices, and notes that only 6 of 22 analysts rate the stock a buy. That's just 27% of analysts with buy ratings, which is quite low. However, from what I noted, there's been significant positive analyst activity recently. According to data from October 29th, following Q3 earnings, at least 6 analysts upgraded SoFi shares with no downgrades recorded in that window. Mizuho raised to $38 from $31, Needham raised to $36 from $29, Citi raised to $37 from $28, Goldman Sachs raised to $27 from $24, maintaining hold. UBS raised to $27.50 from $20.50, and Jefferies initiated with a buy rating. Moreover, according to what I've been tracking, institutional ownership stands at approximately 38% of float. This point is interesting. Recent 13F filings show mixed activity, with some institutions adding and others trimming. This tells me smart money is divided, which creates the choppy price action we're witnessing. The forecast. Where is SoFi headed from here? Now let me address the forecast question, because from my research, this is where it gets really interesting with significant divergence in views. According to the Motley Fool's analysis from this morning, they're highlighting both the bull and bear cases. The bull case, from what they're presenting, rests on SoFi's prolific growth and over 12.6 million members, with additional growth opportunities from cross-selling products and a recovering student loan segment. According to their data, student loan originations rose 58% year over year in Q3, and this segment could continue accelerating. From what they emphasized, tangible book value has surged to over $7.1 billion, up significantly from just a year ago and more than double from 2 years prior. According to management's updated guidance, they now anticipate tangible book value increasing by $2.5 billion in 2025, up from prior guidance of $640 million. That's a remarkable revision that demonstrates the profitability and capital generation of the business. However, according to the bear case presented, the stock's 2025 rally has lifted its valuation, leaving less room for stellar returns next year. From what the article concludes, with the price to TBV ratio at 4.7 times, SoFi is expensive enough that it seems doubtful it can match its 2025 gains in 2026 without clearing what is now a pretty high bar. From my own research into longer-term forecasts, according to 24/7 Wall Street's model that I've been studying, they see SoFi reaching $55.30 per share by 2030. This represents approximately 104% upside from current levels around $27, or roughly 15% annualized returns over 5 years. Their model assumes 10% year-over-year revenue growth, which I actually consider quite conservative given SoFi is currently growing at 38% year-over-year. Moreover, according to another Motley Fool piece published this morning titled, "Here's Why I'm Buying Even More SoFi Stock Now," analyst Matt Frankel argues he's still a buyer of the stock at these levels. From what he's highlighting, the latest Q3 results show why the gains are well deserved, with stellar business performance. From my own modeling that I've been working on, here's what I'm seeing. If SoFi can maintain 25 to 30% revenue growth through 2026 to 2027 and expand EBITDA margins from 16.72% toward 25 to 28%, as fee-based revenue grows to 50+% of the mix, the fundamental value supports $32 to $38 per share over the next 12 months. Moreover, according to my calculations, factoring in crypto trading adoption, stablecoin launch, and blockchain remittances, there's upside to $40 to $45 if execution continues at the current pace. My assessment: opportunity or trap? So let me give you my honest view after analyzing all this data. From my research, I believe we're witnessing a healthy consolidation after a parabolic move, not a fundamental break. According to the business metrics, nothing has changed. Q3 showed $962 million revenue, plus 38% year over year, $139 million net income, 8th consecutive profitable quarter, 905,000 member additions, bringing total to 12.6 million, plus 35% year over year, and management raising guidance across the board. You know, the crypto launch on November 11th was historic, making SoFi the first nationally chartered bank to offer consumer crypto trading. The stablecoin roadmap and blockchain remittance expansion create multiple new revenue streams. The transformation to fee-based revenue, now 43% of revenue, up 50% year over year, is improving business quality and margins. These are real fundamental improvements, not hype. From my view, what's happening is classic Wall Street short-term thinking. The stock went up 80% year to date, so analysts say it's expensive and can't repeat those gains. Cathie Wood takes profits, which creates selling pressure. Retail investors panic because if Cathie's selling, maybe I should too. Technical support levels break, triggering stop losses. It's a self-reinforcing cycle that has little to do with business fundamentals. According to my experience analyzing stocks, these are often the best buying opportunities for patient long-term investors. When a high-quality business executing at an elite level pulls back 15 to 20% on no fundamental news, that's when you accumulate. Moreover, according to historical patterns, after hitting all-time highs, stocks often consolidate for 2 to 4 weeks before the next leg higher. My trading plan for this week. From my analysis, here's my game plan. For traders, the key support level to watch is $26 to $27. If we hold above 26 with increasing volume, that's a potential long entry targeting $29 to $30. However, if 26 breaks, we're likely headed to test 24 to 25 before finding the next support. I'd wait for clear technical confirmation before entering new trades. For long-term investors, according to my assessment, current levels around $26 to $27 represent an attractive accumulation zone. The 19% pullback from $32.73 has reset the technical picture and created better risk-reward. My 12-month price target remains $36 to $40, which represents 33 to 48% upside from $27. Moreover, the 2030 forecast of $55 implies over 100% total return for patient holders. All right, folks, that's my analysis on SoFi as of November 18th, 2025. The stock continues falling due to Cathie Wood selling valuation concerns and technical breakdown, not fundamental problems. Institutional ratings remain cautious with hold consensus and targets around $25 to $27. The forecast shows near-term consolidation but strong long-term potential to $55 plus by 2030. From my view, this is opportunity, not trap, for investors with 3 to 5 year horizons. As always, do your own research and invest based on your personal risk tolerance. Thanks for watching, and I'll see you in the next analysis.